What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be taking a little bit of a deeper dive into the DraftKings Q2 earnings results. This is a stock that has performed extremely well this year and has certainly outperformed the broader market. As many people worldwide continue to work from home, this is definitely considered a work from home friendly stock. However, it's heavily dependent on what's going on in the sporting world. We're going to be taking a deeper look into their financials, we're going to be looking at their management team, and ultimately at the end of the video, I'm going to be letting you know whether I think this is a buy, a hold, or a sell. Before we get started, I just want to let you guys know that over 90% of you guys who watch this content actually aren't subscribed to the channel. If you do enjoy this content, please consider subscribing to the channel. Let's go ahead and jump into the video. Okay, let's take a look here at the DraftKings stock against the NASDAQ, which is the index that it trades under. So when the pandemic started and the market crashed 20 to 30%, depending on what index you look at, DraftKings was actually in the green during this time period year to date. I think this magnifies the outperformances of businesses which are considered stay-at-home friendly. However, the issue is that sports for the most part have been canceled for the better part of the year, so much of their business to consumer profits have been crushed until major sports leagues are going to begin to return. With the return of the NBA, NHL, and potentially the NFL in the fall, many people are anticipating DraftKings to pull in tons of revenue as governments continue to provide stimulus and your everyday consumers continue to turn the stock market and gambling into a means of making extra money. I think the real question here is whether or not DraftKings has already seen most of the appreciation that you would expect from the increased activity on sports gambling. Is the value really here with this stock? Are you willing to pay into this company that's already trading at a $12 billion market cap? College football also announced this week that it's likely canceled for the year. This development represents a major blow for DraftKings. College football is one of the most bet-on sports in the US and takes place during Q4, when the company traditionally generates most of its revenue. I think that if the NFL gets canceled, DraftKings is certainly overvalued. However, the fact that the NHL and NBA are progressing fairly well is a great sign for the company. So now moving on to their financials, and first things first, let's take a look at the financial highlights here. So DraftKings reported a much greater loss than analysts on Wall Street expected, and it dropped about 6% on Friday. A lot of this can be directly attributed to COVID-19's impact on the sporting world. It's canceled entire sporting seasons, events, and obviously adversely affected the growth of the company. Typically, from March to June, there is significant interest from Major League Baseball, European soccer competitions, the NBA regular season and playoffs, the NCAA college basketball tournament, and the NHL playoffs, which have essentially been shut down for multiple months now. One of the key metrics for measuring success in the sports betting business is the average revenue per monthly unique payer, also known as ARPU. You can see here that compared to Q2 2019, there was a $21 increase in ARPU. If you look at the first two quarters from 2019 compared to 2020, there was only an $8 increase in ARPU. This is mainly because the average monthly unique payers, also known as AMUP, for Q2 2020 is much lower than 2019, which brings me to the next graphic. Since the AMUP for Q2 2020 is so much lower than Q2 2019, it actually artificially inflates the ARPU data. In this case, the H1 2019 to H1 2020 comparison is a much better indicator. Even though there are slightly more users in H1 2019, there is still a significant enough improvement in ARPU that shows growth in the company even with a worldwide health pandemic. Breaking down the results from operations a little bit further, you can see that the biggest difference from 2019 to 2020 is the 309% increase or $81.1 million increase in general and administrative costs. Of this increase, $3.8 million was attributable to SB Tech and $4.4 million was attributable to stock-based compensation, mainly related to the vesting and grants of long-term incentive plan awards and the issuance of our Class B shares, which have no economic or conversion rights, to Jason Robbins, who is the CEO of DraftKings. The other big increase came from the cost of revenue, which increased $29.5 million year over year from 2019 to 2020. $18.9 million of this increase can be attributed to SB Tech, including $13.2 million in amortization costs of intangible assets. Excluding the impact of the SB Tech acquisition, the cost of revenue increase would have been $10.6 million. Taking a look at their cash flow statement now, all three activities had significant increases one way or the other. The only one which I'd really like to discuss is the net cash provided by financing activities, as it's given them a massive cash reserve. The increase was driven by a $678.6 million in relation to the recapitalization of the DEAC shares and net proceeds of $190.7 million related to the exercise of DraftKings public warrants, which became exercisable following the business combination. Net proceeds of about $620.8 million were also received in connection with the recent share offering. All these financing activities are one-time occurrences and likely won't happen again. It's now up to the DraftKings management team to effectively utilize this capital. Depending on the cash burn rate, which I believe is highly dependent on the health pandemic, this company should have enough capital to survive the storm here, if you will. One analyst said that their cash burn rate was about 10 to 15 million per month, which would give them about a 4.5-year hiatus before they need to raise capital again, assuming they make no more money from this point forward. Looking at their balance sheet now, the first thing that I'm generally concerned with is whether or not the company has much debt, and you can see that their liabilities are extremely low. Their current ratio is actually pretty high, sitting at 5.375. This is encouraging because I know that there's basically no risk of bankruptcy here with all the capital that they've just raised. DraftKings has enough cash and equivalents to pay down their entire accounts payable, liabilities to users, and other long-term liabilities right now if necessary. They also do have a high amount of goodwill, but that's because of their recent acquisition of SB Tech on December 23rd, 2019, which wasn't attributed to the company financials until 2020. This has also given them a new stream of income via business to business instead of business to consumer. Goodwill is simply the acquisition price which was paid over and above the fair value of the acquired assets. Let's dig a little bit deeper into that acquisition now. If we break down the SB Tech acquisition even further, you can see that most of the value actually came from intangible assets in which the net fair value had to be estimated. Total fair value of the assets acquired was estimated at approximately $505 million. DraftKings paid about $975.5 million, which is where the estimated goodwill comes in here. It's the difference between those two numbers. The intangible assets were estimated as follows: $392 million for developed technology, $93.7 million for existing customer relationships, $4.3 million for trademarks and trade names, and $500,000 for a gaming license, all which have their own respective useful lives which will depreciate over time. The fair value of the developed technology was determined using the multi-period excess earnings method, which is a form of the income approach, also known as the discounted cash flow method. For anybody who understands the time value of money, the DCF is an extension to that theory. The cost of capital, which isn't specified in the 10Q statement, discounts the projected future cash flows of the asset. This is the present value of the future after-tax cash flows of the asset. I'll try to find a picture here of a formula to put up on the screen so that you can kind of explain where I'm coming from. One other thing that I wanted to point out from the accounts payable breakdown was the 91.3% increase in marketing expenses. As DraftKings has had to raise much of their capital to go public, this is just something to monitor as DraftKings continues to evolve over time. I know the sports gambling business is heavily dependent on marketing dollars, but if the marketing expenses continue to increase at this rate, it might be unsustainable moving forward. So just something to keep an eye on. Now, the health pandemic has certainly muddied the water in terms of when sports are going to return to normal. I don't think anybody has a firm date as to when fans will actually be able to fill up the stadiums again. There's also the fact that DraftKings has already severely outperformed the broader market. There's probably not as much value here as there was at the beginning of their IPO in 2019. Even though their net loss reported was much greater than anticipated by most Wall Street analysts, that's almost directly related to the health pandemic, and it is temporary. Key metrics such as the ARPU metric has shown steadiness in revenue per user despite a massive drop-off in users on their platform. The one-time stock-based compensation payout to their CEO, Jason Robbins, basically occurred during a very unfavorable time. Sports seasons and sporting events shutting down is pretty much the worst-case scenario for the stock. The capital that they raised, $1.5 billion in the last quarter, should be enough to get them through this health pandemic. Like I said, an analyst stated that their cash burn rate is about 10 to 15 million per month, and that should give them enough money to survive at least 4.5 years before they have to raise capital again. Also, the sporting seasons being shut down is temporary. The opportunity in this market is incredible. However, it's all about value and what price you're willing to pay. Since the bottom of this pandemic, this stock has already tripled in price. Are you really willing to pay a $12 billion market cap multiple when it was only about $4 billion 4 months ago? With many people anticipating the return to sports in the near future, I'm sure a lot of people are looking to potentially put their money into stocks like this, even though it might already be overvalued. Ultimately, if you think sports gambling is something that is here to stay and will be growing and only be getting bigger from here on in, this is definitely a stock that you should be buying and holding for a long time, although we probably already missed out on the majority of the value that was there to be had. So that's all I have for you guys today. I hope you did enjoy. If you did enjoy, please don't forget to like, subscribe, Share the video with a friend if you learned something, and I'll see you guys in the next video. Peace out.
Young age, learn how to get paid. Big stage, long way from session A. Big wave, he gon' have to get saved.